bringing in an important voice this morning. Andrew Holland, CEO at Avendus Capital Alternate Strategies, is joining us on the show. Good to have you after some time, Andrew. Things haven't really changed much from a market standpoint. In fact, just worsened a bit, I would assume, at least on the global front. What's the take now, and what would the approach be?
Well, I think we're all kind of just waiting, right? It's waiting for what government action may be on certain industries, obviously the tax and long-term capital gains tax. So, can only hope that that's coming soon. But the longer we leave it, the more worried we're going to get about it. So, I think we've been helped more recently, by global markets on the expectation that interest rates are going to fall. And that's really what the expectation will be. So that's the kind of a tailwind for us. But the longer we leave the economy to its own devices, then I think it's going to be harder to kind of shift sentiment in the very short term. So I've been talking to a lot of people, particularly mid and small sized companies, and they say they're in a tunnel and they just can't see any light for a long time. So that's where the sentiment is, and that feeds upon itself. So I think the sooner we have any sort of package or no package, just let us know so we can all move forward.
All right, so while the anticipation and the hope is there that there will be something announced, let's for once believe that it's left as is, as was announced in the budget, and nothing really changes. What happens then? Because earnings have dropped, we've not really seen a pickup. Most brokerages have downgraded their earnings estimate for FY20. They brought it down to now from 25% earlier on to about 20% now. What would the approach change? How will it change then? Would it still be a wait and watch stance? Or would the thought process be to take this as an opportunity, start doing SIPs, start nibbling in slowly?
Well, there's always that expectation of trying to find the bottom, but it depends where you think the bottom is. First of all, I think 20% earnings growth is wildly optimistic, even if they give a package. So we're at more between 10 to 15. So anyway, I think the street has to kind of cut forecasts. So if there's nothing happening, then they will do that. That's for sure. And then obviously we're on a higher P than we should be, and therefore the markets have to correct. And if you don't have the global backdrop of support, now if you just think about it, when we had our problems in July and the market fell by nearly 10% since the budget, global markets were all doing very well because interest rates were falling, so we didn't participate in that. So to participate, we have to show that we're moving forward as well. So that would be my concern, is that we'd all be thinking about what's the next level for the market, and everyone would just continue to fly to safety. So it would continue to be those 5 to 10 stocks which have held up the market for so long.
Actually, I have a follow-up on that too. But Andrew, good morning. Neeraj here. And again, as Devina said, good having you after a while.
Morning.
Just wondering, Andrew, if indeed the government does give some bit of leeway on taxation, be it the surcharge, be it something else, will that be a good enough reason for a large money bag like you to go out shopping seriously? Or is the slowing economy concern enough to hold back on the ammo because there might be better opportunities that could arise?
No, I think this too. So let's take what I think will happen globally. And I think globally we're all convinced that US is spiraling towards recession. So interest rates will fall. They'll fall in Europe. They'll fall everywhere else. It'll fall here, and that will be good in the very short term for equities. So we want to try and participate in that if we can. Now, if, as you just said, there is kind of some rethink on to help the economy or kind of reduce the burden on tax, then what I think investors will think is here's a government that's listened and taken corrective action, and we'll all be a lot happier for that. I think corporates will then feel that they can start thinking about sales growth improving going forward, and therefore we'll think more about capex. So it's a bit of India is a great market. We're either, super bullish or super bearish. We're never kind of in between. And at the moment, we're in that super bearish mood. So we need to shift that kind of sentiment. I don't think it takes a lot. I don't think anyone's, there's a lot of sectors out there still doing okay. But obviously, it's the small and medium-sized businesses which are suffering more because of cash flow problems, whether that's GST, nothing to do with what was said in the budget. So maybe just lowering of GST to one slab, for 1 year, doing something which will just get the economy moving, I think would be welcomed by all, and I think would get the economy back on track.
It's astounding the way the street is split between this limited window GST cut coming in for maybe autos or some other pockets versus what happens to real estate. By the way, the other point that Andrew made is very interesting, and there is a fantastic study done, or a chart study done by JP Morgan, I think, which lays out that whenever this inversion of the yield curves has happened, the period of recession for the markets is a good 11 months away. And the past 2 times that it has happened, there is a significant period before which the markets start to correct. And the point that Andrew was making right now, that if indeed the US spirals towards recession and the interest rates get cut, then you might actually have equities rising and one would want to participate out there. So Andrew, how do you, this is the chart that I was talking about, and it lays it out very, very beautifully in terms of how the markets have done even when these signals have come in. But Andrew, how does one participate then? You mentioned about this flocking towards the top 10 names. We just did a study today which showed that every time there is peak polarization of the top 10 stocks accounting for over 60% of the weightage, the subsequent rally that happens has the bottom 30 stocks in the Nifty participate, and not quite, better than the top 10. So my question to you is, for here on, for the next 1 year, would you look to buy value, or are you parking yourself in the tried and tested?
So I think we're all trying to, think about that scenario. And you're absolutely right. I've seen studies as well saying that if you take the bottom 40 Nifty companies, they're on an index of the equivalent of 9,000. So we know that the broad market is cheap, right? And that's not what we're worried about. It's what's going to be the catalyst to get that going. And because the economy is slowing, and sentiment's so bad, it's the operational gearing of domestic-driven companies which hurt them, and that's all going to be below the top, the top companies in each of the sectors. I'm not saying the top 10 in the Nifty, but the top companies in each of the sectors, and that's what we're seeing. So you're right. If we have a rally, if the government do some of the right steps, then it's going to be the broader market. Those 10 will still rise. But you know what? The other 40 is going to rise a lot quicker. So that's where you're going to see a lot of concentration of money if that was to happen. And obviously, we'd want to participate in that.
All right. Interesting point. However, US, you've not really seen a bear market for the last 10 years. So even at any point of inversion, if you've gone to see, the market has still steadily progressed higher. And these are different times. I think in the last 1 year, there has been one more instance where we were on the brink of, or whether they actually had a yield curve inversion. But at that time, and like this time as well, the underlying is different. The undertone of the environment is different. The global economy is changing. So it may not actually translate into a full-blown recession, according to some that we have conversations with. But Andrew, in terms of specific pockets, again, the same question like Neeraj, even in terms of sectorial picks and what you'd like to invest in, does that change with regards to how these sectors have been beaten down versus how some of the tried and tested financial names have done?
No, it's really, stick to the quality. It's paying you to do so. That they're obviously, in each of the sectors you can see they're taking market share. Yeah, the sales might be a little bit lower than they were before, but compared to the rest of the industry, that it's superb results. But this is not an India problem alone. This is the same in the US and other markets as well. But there's one point I just want to bring up on your yield inversion. And the concern I have about this is not, I'm a great believer in it, but everyone's saying it's this time it's different this time around. It never usually is. I just don't think a lot of people remember what a recession actually looks like, because we've only had a financial recession. That was in 2008. It wasn't an economic recession. And I think the challenges will be a lot different than what you saw with a financial recession, where you can throw money at it. You can't do that necessarily for an economic downturn.
A very important point, and yeah, maybe Andrew's seen that. A lot of modern day money managers may not have even seen that. Andrew, just one last question then. If that is indeed your view, the other view that is being browbeaten right now is that the valuations for the broader end of the spectrum, the small caps and the mid caps, have reached levels from where they have typically bounced back. Do you see fundamental reason to go out and buy those companies at a point of time when we are, as you said, looking at the economic recessionary scenario, if not an actual recession in India?
You know, you're right. I mean, I speak to a lot of investors, and they're asking the same question. You know, should we dip our toes now or should we wait? You know, my view is you can wait to see if there's a package or not, because if there is, yes, you'll get a bit of a rebound. But you know, you can be quick and nimble enough to get into start up a SIP in a mutual fund, not on small and mid cap mutual funds. You know, that's simple to do. But you know, I think at the moment everyone's just thinking, you know, cash might be king in the very, very short term, and just waiting to move from the sidelines. So everyone's looking at exactly what you said, and I think, you know, once they feel confidence to do that, and that goes back to what we talked about at the beginning in terms of any government you know, package or help or incentives, I think will push people towards doing that.